When the stock market crashes, most people see disaster, headlines scream panic, investors rush to sell, and fear spreads like wildfire. But here's the truth. Every market crash in history has created millionaires. Not because they were lucky, but because they saw what others didn't at once. In a decade chance to buy the best assets at the cheapest prices. The question isn't whether another crash will come. It will. The real question is, will you be ready to turn that chaos into opportunity? When most people hear the words market crash, their first reaction is fear. They picture their savings disappearing, their investments shrinking, and their future looking uncertain. And that's exactly why the majority of people lose money during crashes. They panic, sell off what they own, and lock in their losses. But the truth is, crashes are not just periods of chaos. They are golden opportunities. Every major financial downturn in history has produced a new wave of millionaires, not because those people avoided the crash, but because they knew how to use it to their advantage. Think of it this way, a market crash is like a giant clearance sale for assets. Companies that were trading at high prices suddenly become discounted, sometimes by 30%, 40%, or even 70%. To the average investor, that drop looks like disaster, but to the savvy investor, it looks like the opportunity of a lifetime. If you walked into a shop and saw your favorite products selling for half price, you'd be thrilled. Yet, when the stock market does the same thing, most people run away in fear. That's the difference in perspective that separates ordinary investors from the ones who build wealth. History proves this point over and over again. After the crash of 2008, people who bought strong companies like Apple, Amazon, or Microsoft at their lows saw their investments multiply several times over in the following years. The same thing happened during the dot-com crash in the early 2000s. And even after the Great Depression, nearly a century ago, markets always recover over time. And those who buy during the darkest days are the ones who profit the most when the recovery comes. The key is understanding that crashes are temporary. Human psychology makes it feel like the sky is falling, but if you zoom out and look at the long-term chart of the market, you'll notice something. It always trends upward over decades. There are dips, crashes, and recessions along the way, but the overall direction is growth. That's because businesses innovate, economies expand, and populations increase. As long as that continues, markets will keep rising and the temporary dips become the best times to get in. Let's imagine you had the $1,000 to invest. If you put that into the market at its peak, you might feel frustrated when it falls to $700 during a crash. But if you invested that same $1,000 during the crash itself, you'd be buying at the bottom. When the market recovers, your $1,000 could turn into $1,500 or even $2,000 faster than you expect. Multiply that by years of investing and bigger amounts of money. And that's how people build serious wealth when everyone else is losing theirs. Now, this doesn't mean you throw money blindly at anything that's dropped in value. Not every company will survive a crash. Some will go bankrupt and some were overpriced to begin with. The opportunity isn't in buying everything, it's in identifying quality businesses and assets that are temporarily undervalued. That's where the real wealth is built. The crash simply gives you the chance to buy them at a discount. So instead of seeing a crash as a nightmare, start viewing it as an invitation. It's the market's way of letting you pick up valuable assets for pennies on the dollar. Most people will be too scared to act, and that's what creates the opportunity for those who are prepared. Every fortune built during a crash started with one simple realization. Chaos doesn't destroy wealth. It transfers it from those who panic to those who stay calm. When a market crash hits, people suddenly realize the value of something they often overlook during good times: cash. Having cash ready in a crash is like having ammunition in the middle of a battle. It doesn't just give you safety, it gives you power. While everyone else is scrambling, selling assets, or panicking, The person who has cash in hand has the ability to buy opportunities that no one else can afford to touch. Most beginners make the mistake of being fully invested all the time. They think every penny they own needs to be in the market working for them. That's fine when markets are going up, but when the crash comes, they have nothing left to deploy. They end up stuck, watching bargains appear all around them, but unable to act. Worse, some are forced to sell their positions at a loss just to free up cash, which means they miss the recovery entirely. This is why the wealthy and the smart always keep a portion of their portfolio in cash, waiting for the right moment. Think of it like this: if the stock market is a shop, then cash is your shopping cart. When the sales start, you need an empty cart ready to fill. 8. If you've already maxed yourself out, you're standing in the aisle watching other people scoop up all the bargains while you're left with nothing. Having cash means when the crash comes, you're not panicking, you're excited because now it's finally time to buy assets you've been eyeing at half the price. 8. The great investors throughout history understood this. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful. But you can't be greedy in a crash if you don't have any cash." Buffett himself sits on billions in cash during bull markets because he knows sooner or later there will be a crash or a dip that lets him buy world-class companies at fire sale prices. 48. It's not about timing the market, it's about being prepared when the timing shows up. For the beginner investor, this doesn't mean keeping all your money in savings and never investing. That would defeat the purpose of growth. Instead, it means having a healthy balance. For example, maybe 100 to 20% of your portfolio stays liquid in cash or cash-like assets. That way, when opportunities appear, you're ready. This also gives you peace of mind. 2. The 48. Instead of feeling trapped by a crash, you'll feel like you're in control because you've got money waiting to work for you. Cash also protects you from making emotional decisions. Let's be honest, during a crash, fear is everywhere. Friends and family might be telling you to sell, the media is shouting doom, and your own mind starts racing with what ifs. But if you've already set aside cash, you're not pressured to liquidate your positions at the worst possible time. You don't have to sell quality assets at a discount. You've already got dry powder, which means you can think logically while others are losing their heads. Another overlooked advantage of cash is flexibility. Crashes don't just create opportunities in the stock market, they also affect real estate, commodities, and even private businesses. If property prices fall, cash gives you the option to make moves there. If gold or other assets dip, cash lets you diversify. While most people are handcuffed by a lack of liquidity, you're free to choose your opportunities. So when you hear people talk about cash being dead money, because it doesn't earn much sitting in a bank, remember this: during a crash, it can be the most valuable asset you own. It's not about the tiny interest it earns, it's about the doors it opens when the world is on sale. Crashes reward those who are patient and punish those who are reckless. Cash is the tool that allows patience to pay off. The bottom line is this: cash isn't just money. 8. It's confidence. It's the difference between watching a crash with dread or with excitement. When you're liquid, you don't just survive the storm, you're ready to build wealth from it. And that's how ordinary investors miss out. But prepared ones end up walking away with millions when the dust settles. When a market crash happens, it feels like everything is falling apart. Stocks are red, news anchors are panicking, and investors are dumping assets left and right. But here's the truth: not everything that falls in price deserves to stay down. The challenge, T8, and the opportunity is learning to separate the winners from the losers, the strong companies that are temporarily discounted from the weak ones that might never recover. That's how fortunes are made in the rubble. A crash acts like a stress test for businesses. Companies that are over-leveraged, built on hype, or lacking solid fundamentals tend to collapse. Meanwhile, businesses with real value, strong cash flow, durable brands, and a loyal customer base might see their stock prices cut in half simply because of fear. That's where the opportunity lies. The market doesn't always price companies rationally during times of panic. It throws everything into the bargain bin, and it's up to you to dig out the gems. Think about 2008. Banks and risky financial companies were collapsing, but at the same time, businesses like Apple, Microsoft, and Amazon saw their stock prices get hammered. Were they in trouble? No, their products were still in demand, their balance sheets were strong, and they were leaders in their industries. Investors who spotted that difference and bought those stocks when others were selling went on to multiply their money many times over in the years that followed. The same principle applies to every crash. You don't buy just because something is cheap. You buy because it's valuable. A stock dropping 80% doesn't make it a deal if the business is rotten at the core. Think about companies like Lehman Brothers during the financial crisis or certain tech startups during the dot-com bubble. They looked cheap on the way down, but they never came back. That's why you have to look deeper than the price. So how do you pick the winners? Start with fundamentals. Does the company make real profits? Do they have manageable debt? Is their product or service something people will still need 5, 10, 20 years from now? If the answer is yes, then a crash is simply giving you the chance to buy that business at a discount. It's like getting a luxury car at a used car price, knowing it'll still run for decades. Next, consider competitive advantage. The best companies have something that sets them apart: brand recognition, patents, network effects, or customer loyalty. These are the businesses that bounce back first because people don't stop using them just because the market dipped. Even in tough times, people still buy smartphones, still shop online, still use software, still drink their favorite soda. These businesses are resilient, and their resilience makes them prime candidates during a crash. It's also smart to look at leadership. Strong management teams navigate crises better than weak ones. A crash exposes poor decision making and rewards disciplined strategies. A company led by visionaries who adapt and innovate won't just survive a downturn. They'll often come out stronger, grabbing market share from competitors who collapsed under the pressure. Picking winners also requires patience. The market might not reward you immediately. In fact, prices could keep dropping even after you buy. That's why confidence in your research matters. If you've chosen wisely based on fundamentals and long-term value. 8. Temporary volatility won't scare you. You'll know that in time, the market will recognize the worth of those companies and the price will climb again. The truth is, most investors lose money in crashes because they chase hype or act emotionally. They buy weak companies because they look cheap, or they sell strong ones because they're scared of seeing red. But the investors who come out on top treat a crash like a clearance sale. They don't buy junk just because it's discounted. They buy value that others are too scared to touch. At the end of the day, picking winners in the rubble isn't about predicting the future. It's about identifying businesses with a proven track record, a strong foundation, and the ability to weather storms. Crashes don't change the fact that good companies remain good companies. They just make them available at prices you may never see again. And if you can train yourself to spot those opportunities, that's how you build real wealth while others are licking their wounds. One of the biggest mistakes investors make during a crash is expecting to get rich overnight. They see the market fall, they jump in 48, and then they panic when it doesn't bounce back immediately. But here's the reality: the money made in market crashes doesn't come from quick flips. It comes from patience. It's about buying when everyone else is running scared and then holding on long enough to let the recovery do the heavy lifting. Think of the market like a pendulum. When it swings too far in one direction, panic, fear, and chaos, it eventually swings back the other way. But that swing doesn't happen in a week or even a few months. It can take years for the market to fully recover. The investors who build wealth are the ones willing to wait it out. They understand that the seeds they plant during a crash take time to grow into the millions thereafter. Look back at history. After the 2008 financial crisis, the stock market didn't magically recover the next day. It took years. But the investors who stayed patient and held on to quality companies saw their portfolios explode in value over the following decade. The same was true after the dot-com crash. The people who bought Amazon at a few dollars per share and had the patience to hold are now sitting on fortunes. 8. They didn't get lucky. They simply waited while everyone else tried to time the market. Patience is powerful because it works with the natural tendency of markets to rise over time. Businesses innovate, economies grow, and populations expand. Even when there are bumps along the road, the long-term direction is upward. That means if you can endure the short-term volatility, you position yourself to benefit massively in the long term. The impatient investors, on the other hand, often sabotage themselves by selling too early or jumping in and out of the market based on emotions. The trick is to shift your mindset. Instead of thinking about the next 6 months, think about the next 6 years. Ask yourself, will this company or investment be stronger, more valuable, 8, and more relevant a decade from now? If the answer is yes, then why would a temporary drop bother you? Patience transforms fear into confidence because you stop obsessing over daily price swings and start focusing on long-term growth. Another key part of patience is consistency. It's not just about making one big buy during a crash. It's about continuing to invest regularly, even when the market looks gloomy. This strategy, known as dollar cost averaging, smooths out the bumps. Sometimes you'll buy a little high, sometimes a little low, but over time you build a strong position in assets that grow. Crashes become opportunities to buy more at lower prices, not disasters to be feared. Patience also protects you from the noise. During a crash, everyone has an opinion: friends, family, the media. Some will say the world is ending. Others will push you toward risky bets. But if you've done your research, picked solid companies, and committed to a long-term plan, patience keeps you from being swayed by the chaos. It gives you the clarity to stay the course while others are being tossed around by emotions. The truth is, wealth in the markets isn't about being the smartest person in the room. It's about being the most disciplined. Anyone can buy stocks during a crash. Few can hold them when prices keep dipping lower or when recovery feels painfully slow. But those who do are the ones who look back years later and realize that patience turned their crash investments into life-changing fortunes. So when the next crash comes, and it will, remember this: the money isn't made in the panic, it's made in the patience. Plant the seeds, water them with time, and watch as what once looked like chaos transforms into the biggest opportunity of your financial life. The ones who panic will lose, the ones who wait will win. 8. And in the end, that's the difference between those who see a crash as a curse and those who see it as the chance to make millions.